Good morning, everyone. We'll give a couple of moments for people to file in. I am Shannon Stewart, board member of the UCC, and it is my honor and joy to join you and to introduce this morning's discussion, The Death of Digital Transformation in Lending, hosted by Algebrik today. So I'm so excited to see what Andrea has to say to us. We'll give a couple more minutes for people to file in. I hope everyone's doing great on this wonderful Wednesday. Just as we prepare, I'm going to let you guys know we have our third annual upcoming United Creditors Connect conference in beautiful Las Vegas, Nevada in August. We'll talk more about that at the end of our presentation today, but these partnerships have been great. These educative webinars have been phenomenal. And today, I'm confident that this one will be no different. And it looks like we have folks filing in now. This is good. Again, and those of you that just joined, I'm Shannon Stewart, board member of the United Creditors Connect, and we are so excited to partner with Algebrik for this morning's discussion, The Death of Digital Transformation in Lending. As Andrew always says, digital is done, experience is the new battleground, and Andrew is going to talk to us today about joining in on the battleground and tackling member interaction in lending in this new facet. All right, let's get started, guys. So look, I want to introduce you to Andrea. Andrea will be leading today's discussion. She's the Vice President of Business Development in partnership with Algebrik. She has over, get this, guys, and when she told me this, I thought she was lying. She has over 20 years of experience in the credit union and financial services space. She's built a strong reputation for leading transformation through business development, through innovation, through fostering impactful partnerships like their partnership with United Creditors Connect. Andrea leverages her deep expertise in lending management coupled with her passion for AI-driven solutions. And I can tell you firsthand, there's not a ton of credit unions adopting this AI movement. And guess what, guys? This is the new thing. This is the new it. If you're contacting members and interacting with members like you were when I first started collections, October 20th, 1997, you're missing out. Here's another fun fact about Andrea. Andrea is a Cleveland Browns fan, guys. I don't know anyone, even people that play for the Cleveland Browns, like Miles Garrett, you can call him. He's probably not a Cleveland Browns fan. Andrea and her family are Cleveland Brown fans. And so, with that being said, I want to introduce you to the wonderful Andrea. Andrea Silvers, welcome. Thank you for leading today's discussion. How are you today?
I'm good, Shannon. Thank you so much. And that is not an April Fool's joke. I know today is April Fool's Day, but no, I'm kind of a Browns fan by proxy, though. So my husband was a Browns fan, and I really didn't have an NFL team that I really rooted for. So I just kind of tagged along with him, and yeah, it's been a pretty disappointing couple years for us, but that's okay. I digress. So thank you everybody for joining us today. So excited to be able to talk to you all today. We're going to talk about the death of digital transformation in lending, and I know that seems very dramatic, but our marketing team likes to add a little bit of shock factor in their designs. So that's what they came up with. But what we're really talking about and what the death of digital transformation and lending really means is that we digitized lending, but we forgot to design it. So let me explain what that means. Over the last decade, we poured millions into technology, right? We moved applications online. We automated underwriting. We built mobile apps. We added portals, dashboards, and workflows. From the outside, lending looks modern, right? But from the inside, it often feels broken. Borrowers get stuck in long, confusing application journeys. They repeat the same information across multiple systems. They wait in queues with no visibility. Is anyone even looking at my application? Well, somebody let me know if I'm approved, or did they even get my application? They don't know what's happening and what's even coming next. And then loan officers, well, they're spending more time chasing documents than they are advising their members. They jump between 5 or 6 platforms just to close a single loan. They manage handoffs instead of relationships. You know, we digitized this process, but we never really designed the experience. We automated tasks, but we never truly designed the journey. And that's why lending got faster, but it didn't get better. It's the experience that we're talking about. Digital lending is just the first step, and it's what happens next that really makes the difference. So, this webinar today is just about that. It's about the lending experience and what needs to change. So, the lending journey today, it's fragmented, right? We can agree upon that. There's too many steps, there's too many systems, there's too many handoffs, there's too much waiting and too much uncertainty. But here's the uncomfortable truth: we didn't transform lending, we just automated the old way of doing it. We added digital channels, we added automation, we added point solutions, but we never actually redesigned the journey around how people experience lending. So, what did we build? We built a faster machine, sure, but it's a colder experience and it's a weaker relationship. We made lending more efficient without making it really feel better. And that's what created the paradox that we're living in today. So let's give this some context, okay? This is the typical lending journey most borrowers are experiencing today, not because credit unions don't care, but because the journey was never intentionally designed end to end. It starts with a lengthy, complicated application. Right out the gate, about 20% of your borrowers are going to drop off just from friction and form fatigue. Too many clicks, too much scrolling and typing, creating passwords and then recreating passwords and then creating another password because the first one didn't meet the password guidelines. Those who do figure out the password debacle and then continue on, they hit the next wall, which is documentation, confusing uploads, multiple requests, errors in file uploads, incorrect documents uploaded, and then the back and forth emails. That alone adds 3 to 5 days to the process. And then we move into manual checks and verification, human reviews, and disconnected systems. At this stage, about 35% of applications get delayed. And then next comes credit. Not one clean flow, but multiple disconnected credit systems, more waiting for the member and more handoffs for the loan officer. So now we're at 40% of applications experiencing delays. And then we move on to approvals. So instead of clarity, members are waiting on average about 7 days just to move forward to the next step. By this point, your member is pretty much out of patience. And when the members do finally get their approval, about half of the borrowers have already abandoned the journey altogether. And even after the approval, the journey still isn't over. Disbursement delays cause another 10 to 15% drop off. Now, here's some key insight. None of these problems are about credit risk. None are about compliance. None are about technology gaps. They're about a journey that was never designed as a journey. Each step works, but the experience between the steps breaks. This is what happens when we automate tasks, but we never really orchestrate the flow. And this is the real cost of undesigned lending: lost growth, rising costs, and faded trust. So let's go ahead and take a poll right now. Can we move to the next slide? All right. So where do you think most lending journeys break today at your institution? Is it application and onboarding, documentation and verification, underwriting and approvals, post-approval and funding, or honestly, all of the above? What do you think? What's happening at your institution today? All right. Do we have some results here? Okay. So 36% of you say it's pretty much all of the above. We also have a few from application and onboarding. Next is documentation and verification. And then we have a tie between underwriting approvals and post-approval and funding. All right. Makes a lot of sense. Very interesting. Thank you for participating. So let's move on. I want to provide some data for the argument that we've been making here. So let's move on to the next slide. All right, so on the financial side, credit unions really are not struggling. In fact, 88% reported positive net income in the third quarter of 2025. That's up from about 85% a year earlier. This is an indicator of improved profitability across the system. And at the median, assets grew about 2.6% year over year, showing resilience in balance sheet strength. But here's where the story gets a little interesting. When we look at growth and loan momentum, the trend is not as robust. On average, loans outstanding rose only about 0.3% year over year in that same period. This is slower than deposit growth and overall system expansion, which points to lenders being cautious or constrained. And membership tells a similar story. While overall membership is up, many credit unions actually saw membership decline about 0.5%, signaling real challenges in organic growth. We're also starting to see early signals of experience-related stress showing up in performance metrics. The average total delinquency rate was around 67 basis points in third quarter 2025. This is slightly higher than prior year levels, indicating credit normalization and some pressure points. And the average loan to share ratio sits at around 70%, which suggests a lot of liquidity isn't being deployed as aggressively as it should. This is a classic sign of friction in origination and member engagement. So here's the conclusion this data points to. Credit unions have the financial strength to lend. They have the capital and they have the liquidity, but they aren't translating that strength into velocity, which in the credit union world is at the speed of which members borrow and relationships grow. This is exactly where the experience, or lack thereof, becomes a balance sheet issue and not just a customer experience one. That sets the stage for why the next transformation has to be about removing friction and reconnecting growth with experience. Next slide. So here's the paradox at the heart of modern lending. On the surface, lending has never been faster, right? We've moved applications online. Credit is instant. Rules are automated. Documents are digital. Everything appears fast and easy. And from a systems perspective, everything works the way it's supposed to. But from a borrower's perspective, the journey still feels worse than ever. Long forms, confusing steps, repeated questions, unclear timelines, status pages that say nothing, and the constant feeling of, did my application even go through? Inside the credit union, it's not much better. Loan officers juggle multiple systems. Operations teams manage endless exceptions. Underwriting chases documents. Branches restart the digital journeys, and contact centers fill in the gaps. So, what happened? We automated steps, but we never designed the journey. We digitized tasks, but we never designed flow. And that's how we created the experience gap, a world where decisions are fast, but journeys are slow, where technology is powerful, but confidence is weak, where automation is everywhere, but trust is eroding. Automation without orchestration creates friction, and friction kills momentum. That's the real cost of fragmentation. So let's go to another poll. What do you think is the biggest barrier to lending growth right now? Do you think it's credit risk and underwriting? Is it interest rates and margins? Is it member drop off and friction, lack of demand, or operational capacity? What do you think's happening right now? I'll give you a few minutes. All right. Do we have some answers? All right. So we're kind of across the board here. Looks like credit risk and underwriting stands out the most. Um, and then tied for next is interest rates and margins, member drop off, and operational capacity, with lack of demand coming in last. So very, very interesting. Very interesting. Thank you guys for participating. Let's move on to the next slide. So this is the shift that the industry is standing at right now. For the last decade, we focused on automation, everything automation. We automated applications, we automated underwriting, documents, compliance, and automation did what it was supposed to do. It made lending faster, but it didn't make lending work any better because automation optimizes tasks. It doesn't design the journey. What credit unions need now is orchestration. Orchestration is not about doing individual steps faster. It's about connecting every step into a single flow. In the old model, we built isolated systems. We processed loans step by step. We moved files through queues. We relied on manual handoffs. We spent our time fighting fires. In the new model, journeys are connected end to end. Workflows run in real time. Routing is smart, and when something breaks, the system recovers on its own. Automation gives you speed. Orchestration gives you reliability, scale, confidence. That's the operating model that today's modern lending needs. This is where most lending models quietly kind of fall behind. They're still built around the idea of an application. Fill out a form, upload documents, wait for a decision. But that's not how modern borrowers behave. Borrowers don't want to start with a form. They start with a question like, do I want a new car? Do I want to consolidate my debt? Do I want to go on that big vacation? They explore, they compare, they switch screens, they look for instant answers. They behave like online shopping customers. If you shop on Amazon, you know what I'm talking about, right? So they expect options before they commit. They expect journeys to continue across channels through mobile, tablet, laptop. They expect clarity before signing any paperwork. One product, one channel, one rigid path. That's the mismatch. Borrowers live in moments. Lending still lives in forms. And that's why the experience has become the real battleground. All right, let's take another poll. I know I've got a lot of polls here, but I want to keep you guys engaged. So which best describes your current lending operation? I'm interested to know what you guys think about this. Is it mostly manual with digital forms? Is it automated decisions but fragmented flow? Is it integrated systems with handoffs? Is it end-to-end journey orchestration, or is it truly experience-led? Where are you guys at right now? Right. Do we have some answers? Okay. So it looks like we have some integrated systems with handoffs leading the way here, which is great. Next, we've got a tie between mostly manual with digital forms and automated decisions, but fragmented flow. So nobody chose end-to-end journey orchestration or a truly experience led. So it's probably a good conversation today, then, huh? All right, so let's take a step back and let's rethink what borrowing actually looks like today. So, modern borrowing is not a workflow, it's a decision journey. People don't wake up thinking, I need a loan today. Instead, they think, can I afford a new car? Should I renovate my home? Should I take that luxury vacation? Is it time to consolidate my debt? It starts with intent. Then it happens in moments. A quick search on their phone, a comparison on their tablet, question for a loan officer in a branch, and then maybe a follow up later that evening. People decide in bursts across screens, across days, across interruptions, and every time life gets in the way, the journey either resumes or it breaks. And finally, borrowing only moves forward with confidence, not with clicks, not with forms, but with clarity. Do I qualify? What will this cost me? What happens next? When people feel confident, they move forward. When they feel uncertain, they wait. So, the job of modern lending systems is no longer to just process applications, it's to support borrowers' decisions. You're no longer building workflows, you're designing borrower experiences. So, once you accept that modern borrowing is a decision journey, the system underneath has to change. You can't power this with static workflows. You can't power this with rule engines alone. You can't power it with disconnected tools. You need an intelligence layer. Generative AI is what makes sense of complexity. It explains options, it summarizes trade offs, it translates policy into plain language, it turns dense data into clarity for both borrowers and loan officers. Agentic AI is what turns intent into action. It doesn't just wait for inputs, it initiates workflows, it orchestrates the journey, it moves cases from end to end, and it removes friction as it appears. And then there's the most important layer, it's the people, because no amount of intelligence replaces reassurance. No amount No model replaces judgment. No automation replaces trust. This is the modern lending stack. Generative AI explains, agentic AI executes, and people build confidence. That's how decision journeys actually run. So let's take one more poll question. What do you think would most improve borrower confidence today? Do you think it's faster approvals, clearer offers and decisions, fewer document requests, better status visibility, or all of the above? All right. Well, no no surprise there. Most everybody answered all of the above. We have a few that answered fewer document requests and a few that mentioned faster approvals. Document requests. I mean, gosh, you keep asking for document after document after document, and even though it is crucial to getting that loan approval, it's for the borrower, for the member, it's exhausting. So yeah, we need to find a better way to make that experience better for the member so that they're not exhausted with all that we're asking them to do. All right. Thank you for that. All right. So at this point, the question every leader asks is simple. What does great lending actually look like in practice? Not in theory, not in a product demo, but in the real world. This is the blueprint that most high performing institutions are converging on. We call it the CLEAR framework because great lending is built on clarity. So, first, it's context travels, right? A borrower should never have to start over. Their intent, their data, their history, their questions, all of it should follow them from mobile to web to branch to the call center. When context travels, conversations get better. Second is logic is visible. People don't need perfect outcomes. They need understandable ones. Why do I qualify? What do I qualify for? Why did I get this rate? Why is it on these terms? When decisions are explainable, trust accelerates. Third, execution is invisible. Everything that doesn't require a human should disappear. Data pulls, verification, policy checks, document handling. The borrower should feel the momentum, but not the machinery. Fourth is assistance is always on. Silence creates anxiety, right? Waiting kills confidence. The system should always answer three questions: what's happening, what's next, and how long will it take? And finally, relationships lead. Technology doesn't replace trust, it creates space for it. When the machine runs quietly in the background, people can lead at the center. And what modern borrowing looks like is not faster forms, not better portals, but clearer journeys. And when clarity is designed into the experience, confidence becomes the conversion engine. This is where the clear framework becomes a real operating model. Instead of talking about maturity in abstract terms, we can now measure it across 5 experience dimensions. So let's start at the bottom. Digital first institutions put forms online and move documents to portals, but context doesn't travel. Logic is opaque. Execution is visible. Guidance is limited. Relationships still depend entirely on people. That's basic digital access. It's not experience designed. Automated institutions add rules, engines, and instant credit. Decisions are faster, but still kind of hard to explain. Execution is better, but still visible. And assistance is minimal. Integrated institutions connect systems with APIs and portals. Data moves, but journeys still break. Context is partial, and guidance is still weak. Orchestrated institutions are where things start to change. Journeys run end to end, context travels, execution disappears, decisions are explainable, routing is smart. And finally, experience led institutions design lending around confidence. The borrower always knows where they stand, what they qualify for, what happens next, who is helping them. Technology fades into the background and trust moves to the center. This is the maturity curve modern lending is moving towards, and it gives every leadership team a clear diagnostic. Where are we today? And what would it take to move up one level? Experience led lending is not about having better tools, it's about building a different kind of system. Can we move to the next slide? One that starts with intent. Borrowers, they don't want products, they want outcomes. buying a car, renovating a home, paying down debt, starting something new, going on that vacation. The system has to understand the why before it talks about the what. Then context has to be cautious. Identity, income, assets, documents, history. All of it should move with the borrower across channels. There should be no restarts from the first question. No repetition, no friction. Structuring has to happen in real time. No static rate sheets, not rigid product grids. Dynamic offers built around who the borrower is, what they need, and what they qualify for in that moment. Execution has to become invisible. Data pulls, verification, policy checks, compliance, all of it should just happen. And finally, confidence has to be designed into the journey. People should always understand why this offer, why this rate, why this decision, and what happens next. When experience leads, technology disappears. And that's what experience-led lending really means. So I want to close with a simple truth. Digital transformation made lending possible. Automation made lending fast. Orchestration made lending work. But experience will decide who wins. Over the last decade, we invested in technology. Over the last decade, we will be judged on trust. The institutions that lead won't be the ones with the most tools. They'll be the ones with the clearest journeys, the ones with the least friction, the ones that feel safe, simple, and human. The priority has changed. It's no longer about modernizing systems. It's about designing journeys. It's no longer about optimizing steps. It's about protecting momentum. It's no longer about adding tools. It's about building confidence. The future of lending will not be built by IT roadmaps alone. It will be shaped by experience leaders. Because when borrowing feels clear, when decisions feel fair, and when people feel guided, growth follows. And that's the new strategy. So, thank you for joining us today. I'm going to ask Shannon to pop back on. I hope you were able to take away some information to start building the lending experience for your borrowers.
Andrea, thank you so much for that. I there were a ton of nuggets in there. Um, you started out talking about when automation improves tasks, but it doesn't design the journey. And guys, if you have questions, I didn't see any questions in the chat, but please feel free to drop your questions in the chat. Let's see. Hang on, let's see if we have any questions. There was one question in regards to some of the things that you're seeing regarding the application process and bottlenecks. And the transfer, is this applicable to both business lines of credit and consumer lines of credit? So if you want to talk a bit about that, Andrea.
Yeah, I think mainly we're talking about consumer lending. Business lending tends to be a little bit more involved. There's a lot more involved in the underwriting of business lending, but I think the same concept can be applied in both consumer lending and business lending. Really, I mean, we're talking about the experience, right? We want to make the
Mhm.
experience better for the borrower. It's not, if you've ever been on that side of it, if you've ever applied for a mortgage or whatever, it's the pain points if you've ever done it. Wouldn't you like to work with a company who's making it so much easier for you so you can do everything very simple, very quickly without a lot of friction points, a lot of bottlenecks, a lot of back and forth, the emails, the back and forth, uploading documents, uploading the wrong documents, uploading the documents again. So I think that the concept can be applied both in consumer lending as well as business lending.
Andrea, a common discussion that I think I have as an industry professional when I'm discussing the AI opportunity and the growth of AI is the fear. And you said something that I thought was interesting. You said, borrowers like to explore. And, I think I was talking about this to you a couple of days ago when we were speaking. I took my first collection call October 20th, 1997. And I think the manner in which you interact with members today is vastly different than the manner in
Mhm.
which you interacted with members back then, unfortunately. Can you talk a bit about,
Sure.
what you're seeing and what you forecast as the changes to occur in the lending space going forward?
Yeah, we talk a lot about this next generation coming up and how, this generation that's coming up is way different in what they're wanting and needing from us than, you and I right now. Shannon, you and I are both Gen Xers. And the way we applied for loans when we were in our 20s and 30s is way different than the 20-year-olds and the 30-year-olds are applying now. And that's what they've always known, right? They've always had everything at their fingertips. They can get any information they want just by doing a quick Google search or chat GPT or whatever it is that they're looking at. So I think that um, technology needs to make sure that we're on the forefront of what those members and those borrowers are needing and wanting so that we can make sure we're providing that instead of constantly chasing after it. Um, there's a reason why credit unions don't compete against other credit unions. Credit unions compete against the fintechs because the fintechs are building this technology every day. Um, and credit unions are trying to play catch up to make sure that they can compete with those fintechs. And look, there's enough technology out there now for credit unions to definitely compete with fintechs. It's just
Right.
a matter of using the right technology and making sure it's right for your credit union and your members.
It's interesting. You said something, and I wrote it down. You said, when clarity is designed into the experience, confidence becomes the conversion engine. And so, as you talk about, fintechs being the leading um, force in a lot of this, I think I was at a fintech during Series A and B of the cash raise prior to transitioning back into the credit union space. And one thing I noticed is this, though the fintech was ahead of the times in the technology, the fintech didn't have the heart or the mind of the member at in play. And so, if you could
Mhm.
touch on a bit of some of the failures that you're seeing in the credit union space by the lack of adopting the AI model, this technology model, and where that could
Yeah,
lead credit unions ultimately.
absolutely. Look, people are still at the heart of what we do at credit unions, right? I mean, it's people helping people, and I will go to my grave thinking and believing that you can't run your business without people. Um, the technology makes things so much easier. It makes it faster, right? We just talked about all of that, but when it comes to questions, when it comes to if the member wants to know whether or not something is better for them, that's when they need that human person to let them know which is the better route to go. Should I take out a personal loan to fix my car that keeps breaking down, or can I afford a new car so I don't have to worry about putting money into this old car that's got a bunch of miles on it? I don't know. What do I qualify for? Should I do that? Should I keep this old car? Should I invest in a new car? That's where that's where the member experience comes in. That's where that human element comes in. That loan officer can sit down with your member and say, hey, let's take a look at the whole picture here. Because you actually qualify for maybe a $30,000 car loan rather than getting a $5,000 personal loan to fix this old car that's got 150,000 miles on it that keeps breaking down every few months. Um, Maybe that member didn't know that they could qualify for that
Right.
amount of loan. So it takes those people to really sit down and take a look at the whole picture and talk to the member to let them know what they can and can't do. The member can start the application journey, and then once it gets to the loan officer for final review, that's when I think there's a probably a very important element of picking up the phone and saying, hey, member, I see that you applied for a personal loan to fix your car, but you probably saw in the application journey that you qualify for actually a little bit more. Do we want to have a discussion about that? Because I think that might be the better option for you to go. Not many people get that in the tech world. They
Right.
get their technology, they apply online, they get their approval on that personal loan that they wanted to fix their car, and off they go. But they don't get that phone call from that member service rep or that loan officer from the credit union to say, "Hey, I think I might have a better option for you."
Yeah, I think you're right. If I think back, I mean, this was years ago in the fintech that I helped found. Uh, the goal was for us not to talk to members. Like that was our whole goal, to reduce
Yeah.
overhead and not to talk to members. Now we do have a question that came in online. And first off,
Mhm.
I'm a bit miffed that you identified me as a Gen X. I'm a Gen X that I identify as a late stage millennial. The gray in
Oh,
my
okay.
beard has been caused by the lack of adaptation to the AI space. I wouldn't have this gray in my beard if I had adopted AI earlier. The first question to come in, it says, can you comment on the compliance risk and the risk arising from data exposure to the public in the AI space?
Ooh, that's a great question. I think as we get more and more comfortable and adapt more to AI in the lending space, obviously there's going to be compliance has to be a big factor in that. But I think that the way AI is being used in lending today, um, I don't think there's much of a compliance risk, if at all. We're not taking control of the decision when it comes to decisioning loans. We're helping it be a little easier. So, I'm probably not the best person to talk about compliance. It's not really my background, but I can tell you that I think I think, and probably there's a lot of information out there about AI and compliance and risk, but obviously it's definitely something that needs to be probably reviewed before you make any decisions on any AI component within lending.
And let's see. Ah, here's a statement that you made, and it kind of sparked an eyebrow raise. You said, when people feel guided,
Mhm.
growth follows. Talk a bit about that, because I thought that was an extremely profound statement.
Yeah, again, it goes back to that member applying for a personal loan to fix their car. If you have a loan officer helping that member make the right decision, because maybe the personal loan really wasn't the right decision, but they didn't know that they could apply for a car loan. They didn't know that they could afford a bigger loan. But when you have somebody guiding them and saying, "Hey, you actually do qualify. Let me show you the numbers. Let me show you, based off of the information I have and based off of how we're calculating everything out. This is how you can qualify. I have a couple dealerships I can refer you to, whatever the case is." um, that builds trust with that member, right? They're going to trust that, okay, they're not just taking my money and running, they're actually looking out for my best interest. They knew that this personal loan probably, I'm going to be paying on this personal, and then my car is going to break down again. And then what? Am I going to have to take out another personal loan to fix it? So that when the trust builds, that means that member is going to maybe bring some more business to you, right?
Mhm.
Maybe they're going to then apply when they're looking for a mortgage, they're going to apply for their mortgage through you. They're going to tell their friends and family, "Hey, I went to ABC Credit Union and they gave me great information and they really guided me in what's best for me. Instead of taking out this personal loan, I actually got a new car. This car's got a warranty. I don't have to worry about fixing it every other week." And now their friends and family are thinking, "Huh, maybe that sounds like a good place I need to be doing my banking." So it kind of, I mean, it starts with the conversation, and all you're really a member service rep or a loan officer or whoever, they're just doing their job, right? But that answer and that guidance that they're giving that member can grow exponentially because of just giving them other options that the member may not have even thought they had.
So, if I understand you correctly, and I was speaking to a credit union executive a couple of weeks ago about this, is as you talk about the introduction of AI, particularly for credit unions that have been averse to the adaptation of this new model. Uh, every executive that cares about their team says, "Well, hey, I don't want to lose team members." However, what I'm taking from what you're saying is that it adds a degree of thoroughness, but it
Mhm.
also allows the credit union and the lending team to embark on, handling tasks that really need to be handled with a human touch. And some of the tasks that are more time consuming. I mean, I don't think we'll ever have an erasure of the human element for complex tasks.
No.
And you can kind of tell me if I'm wrong with this. I think this is a great supplement um, to tasks that are offered.
You are 100% correct. I think without the AI component, most loan officers or processors or member service reps or who have you, they're spending a lot of time doing tasks that can be automated. And it doesn't mean that their job's going to go away. That just frees up their time to do what they do best, right? What they do best is building that member relationship, sitting down and talking with the member. They can be talking with the member while the automation is going through the workflow in the background, right? We talked about that today too. The member
Right.
shouldn't know that that's happening, but it's happening. And now all of a sudden, oh, hey, Mr. Member, I have an approval for you. All the paperwork's already complete. I just need you to sign right here. We can deposit the funds in your account today. It's AI shouldn't take the job of your people. And if you're doing things right, you should AI should be helping to free up your members to be able to spend more time or helping your team spend more time with their members to help build those relationships so that they continue to grow with your credit union, bring in more members, um, grow their wallet share. That's what it's designed to do. It's not designed to take anybody's job away. That's not what we're trying to do. We're just trying to make those manual tasks, those repetitive manual tasks that everybody hates. We're making that a lot easier on everybody. I know there's a lot of manual stuff that I do that I wish I could do through AI right now, and I'm sure there's probably some solution out there that would be great for me. But then, that would free up my time, and then what do I do? I have conversations with people like you, Shannon.
Yeah. I mean, so Andrew, will let's wrap up by doing this. Can you tell the people how to get in touch with you, the services you provide,
Absolutely.
and how you can
Yeah,
help them?
sure. So I am with Algebrik AI. We are a full suite loan origination system, cloud native, AI powered. We have a digital account opening products, point of sale application, the actual LOS. We also offer portfolio analytics and a decision engine, all within our loan origination suite of products, which we call Algebrik One. My contact information is on the screen right there. You can call me, you can email me. If you want more information about Algebrik, you can visit our website, algebrik.ai. And I'll be happy to answer any questions, or if you would like to schedule a demo of our system, I'd be happy to do that also.
And guys, Andrew will be joining us for our third annual United Creditors Connect conference held at the beautiful Venetian Hotel and Casino in Las Vegas, August 10th, 11th, wrapping up on the 12th. If you thought year one was great, which it was, I mean, I've been on the board, so year one was phenomenal. Year two was better than year one, but year three, we're really stepping it up. It's not just a collection conference, but it's collections and lending, because I personally believe that collections and lending, we go hand in hand. When I was at schools first, a buddy of mine, their lending manager, Daniel, he's still there. He would always say, my job is to keep you with a job. And I said, well, don't do that great of a job doing that. And so Andrew will be there, her and her team, a ton of others will be there. And you know who else will be there? Michael Irvin, three-time Super Bowl champion from the wonderful Dallas Cowboys. Now, the Dallas Cowboys are plagued by pain and disappointment, not as much as the Los Angeles Raiders that live in Las Vegas, or, of course, not as much as the Cleveland Browns. But Michael Irvin will be there.
Yeah.
It'll be a great time, and I'd appreciate you joining us. So, when you registered for this, you should have received the link. You can check us out at unitedcreditorsconnect.com. There's still scholarship opportunities available, and we'd love to see you. And that's it today. Andrew, I want to thank you for taking the
That's it
time to
today.
join us this morning, for leading this insightful conversation. I want to thank all of you that signed up, took time out of your day to join us, and be blessed as you continue to serve your members. Thank you guys so much. Have a great day, and we'll see you soon.
Thank you. Bye bye.